Imagine you open up your brokerage account and all of a sudden you see a big fat zero. Your stock has gone to just $0. That's actually happened to me one time when I bought this company, Intelstat. I follow this hedge fund idea. I bought the stock and then one day I looked into it and the stock price was zero. It went bankrupt. And it's all because I didn't pay attention to the signs and I lost every single dollar that I invested into that company. I'm gonna show you how you can avoid that mistake by showing you the 5 types of companies that really are designed to fail. And this comes from my experience as an equity research analyst, backed by research on predicting financial failures so that you can avoid losing money buying these failing companies. Because if you're actively selecting stocks to beat the market, the skill is not only to find investments that give you higher returns, but also to be able to avoid the stocks that give you the worst losses. Because when you have more exposure to upside and less exposure to the worst downside, that's how you get better returns over time. So let's dive in. The unprofitable story stock, a company called 2U. Ticker used to be TWOU. It's now bankrupt. Now it's called a story stock because the company has no profits. The price is driven purely by the stock's story. So for background, 2U was helping US colleges put their programs online. And when I was covering it at BMO as an equity research analyst, it was an exciting story because they were signing on all these big name schools like USC, Duke, even Harvard. And here's how the business worked. They would put up all the upfront costs, $2 to $3 million per program. They would do all the marketing and in exchange, take a cut of the tuition of about 60% for the next 10 years. The problem with this company and why it failed comes down to profitability. Marketing usually takes up about 10 to 20% of sales for a usual college. Because 2U was taking just a cut of that, that implies that about 25+% of revenues should be going to marketing. 2U was not very good at marketing. Every year they spent 50 to 60% plus of their sales on marketing expense. Now, if we assume also the costs that were required to build the program, a payback period of 4 to 5 years, assumes about 20% of sales each year. So that means about 70 to 80% of sales used for costs, all the marketing and upfront costs. And that's before even paying employees to run the business. So each year they were spending 120%, 130% of their sales on costs, meaning they were losing money every single year. The company couldn't even give you a forecast of when they would turn profits and when they would actually start producing cash flow. The business model really had some fundamental flaws. It's very hard to see whether this business could be profitable. When you look at their financials, you could see this clear pattern that revenues would keep going up while cash flows would just keep going down. And they would keep raising money and just keep burning it. They never turned a profit in their entire years of being in business. The CEO eventually got desperate, started using the money, buying these smaller online education companies, thinking that would solve the marketing problem. And it did not solve it. When they tapped out the equity markets, they started to raise a bunch of debt. And ultimately, the company filed for bankruptcy because it was never able to turn a profit, except maybe in the last year. But by that point, it was too late. If a company can't show a positive profit at some point in the future, that company you got to stay away from. This case study is Apollo Group. This is a company that just keeps shrinking. Apollo was once the #1 for-profit college operator in the US. It was University of Phoenix, which Apollo owned. They had campuses all over the US. So why did they go from being the top for-profit operator to ultimately failing? One is that the demographics changed. The peak for college students was around 2011, 2012 in the US. And that's because the millennial generation, that population, most have already gone to college. So the next generation, Gen Z, was actually a smaller group of people. So the number of college students started to decline after those years. The Obama administration in 2012 also decided to restrict for-profit colleges by reducing loans for for-profit programs. In the US, a lot of students rely on government funding, student loans to pay for school. As a result of the demographics and the cut in those funding, you had less students and just less money overall for Apollo because that market was shrinking. So the factor here is growth or negative growth. The second thing is the nature of Apollo's operation. So Apollo, because they had campuses everywhere, when you have fewer students, if you think about it, you can't shrink the buildings that you have, right? And you also have teachers, you have support staff. So when sales come down because you have fewer students, your costs stay relatively fixed. your profits are basically wiped out. And that's what we call negative operating leverage because you have fixed costs. So you're stuck owning a bunch of these assets that aren't making you money and keep taking your costs. The value of this stock kept getting lower and lower. We pitched this to value investors at 5 times EBITDA. So that's an earnings measure for cash earnings, but it just kept going lower and lower and lower. And the reason why is because they couldn't get rid of those expenses. And if you think about it, if you're a buyer, how are you going to price these assets if they're not even making money? So the buyer only stepped in at 1 times EBITDA. So 1 year of cash earnings is what this company was ultimately bought out for. So when a company can't grow because it's in a shrinking market and it's also shackled with assets that just don't make money anymore, usually that's a recipe for the company to fail or ultimately go into financial distress. Now, by this point, you probably got the idea. It's like, okay, so if a company keeps losing money, it's designed to fail. So what actually is the trigger point for a company to just go into a zero, from a financially distressed into a bankruptcy situation? That brings us to our next case study. Corinthian Colleges, the stock that just has way too much debt. Corinthian Colleges was just like Apollo. They operated a whole bunch of for-profit colleges. They were actually one of the top operators as well, except they used a lot more debt. They borrowed money to grow and build out their campuses. They even had their own loan program to help students pay for their tuition. So research shows that bankruptcy warnings usually happen 2 to 3 years before the actual event. That's exactly what happened with Corinthian. They started having problems in 2013, just like Apollo, with declining growth and that negative operating leverage. So their profits are basically wiped out. So why did Corinthian go bankrupt while Apollo got bought out? The problem was the debt. So they had $150 million in debt. That's not that big of a deal if you have $100 million in cash flow. You can pay that back in 1.5 years, technically. But it's a real problem if you make $0. And the second issue is liquidity. That problem becomes a serious problem when you have to pay it back.
Where's my money? You gonna give me my money? Where's my money, man?
And that's exactly what happened with Corinthian. They had $120 million due in 2015. And then they had about $50 million in cash. So if you think about it, this company now has to generate $70 million from their operations. No chance if there's no growth and they have too many costs. The only other option is you have to restructure the debt with investors. So change the payment terms, find cash either from a bank or from investors so that you can extend your borrowing to pay it back over time. When you have liquidity problems, that's when things get really bad for companies. What happened with Corinthian is because they had negative profits, it actually violated bank covenants, which are rules for loans. So their banks cut off any additional credit that they would give them. The Department of Ed also put a pause on student loans funds, a delay in funds to pay for their tuition. And no investor, because of all this mess going on, wanted to buy them out. By 2015, because they didn't have the cash to pay down their debt, they immediately went to bankruptcy. That's how the stock dropped from a couple dollars all the way down to zero. So let's get into 2 more companies that goes more into the reasons of why companies fail and some of the other early warning signs. Company with a promoter CEO and just terrible execution. We're going to talk about Playboy, slightly different topic. Playboy was actually bought out by a private equity firm. They relisted the company into the public markets using something called a SPAC. So that's a special purpose acquisition vehicle. It's an empty company that's already on the stock market and they just buy up Playboy. So now Playboy is now public. Now, the problem here is that because they're a SPAC, they were able to get away with a lot of crazy projections. Companies normally have to be very careful about the projections that they make in their IPOs, which is when they take their companies public. The Securities and Exchange Commission has very strict rules about your projections because you're liable and you have to be able to disclose your assumptions. When I was part of the IPO process for Laureate as an analyst, we sat down with management for 2 straight days, the entire day, going over business projections and assumptions. So that's the kind of rigor that companies go for normally in IPOs. The SPAC threw that all out the window. Playboy was able to come out and just put out crazy projections. Their strategy was like, we're going to convert Playboy into this new consumer product brand, and we're going to get to 300 million in revenues and 100 million in EBITDA or earnings in 4 years. And the company only had about $70 million in cash at the time. So pretty aggressive targets, especially because the CEO had no operating experience. There was no actual plan given to investors. It was just a fantasy. They made a deal. They bought a lingerie company. Within 2 years, the company started to decline. The company's revenues went from 250 to 125 million. So disaster. So the company hasn't failed yet because now their new plan is they've outsourced all their operations to a partner in exchange for a cut for using the Playboy brands. The big warning sign, if a company doesn't have a plan to reach their targets, if you can't see step by step how they're going to get there, that's a sign of a management team that has no experience. That's how a company can, like Playboy, go from a great company, great asset, to a shrinking, no growth experience. Tattoo Chef. The company has negative unit economics, meaning the product itself cannot make money. Tattoo Chef sells plant-based frozen food. It's similar to Beyond Meat plant-based food products. It's a big trend, at least here in the US. So in any product-based business or any kind of service business, you got the price of the product itself, right? So say they're selling their frozen plant-based cauliflower pizza, and the cost of the product itself is the cost of the cauliflower, turning that cauliflower to pizza, the cost of freezing it. So the price of that product minus the cost of that product, that what you get left is the gross profit. And that's the profit per unit of the product, right? That's why it's called unit economics. And gross profit as a percentage of the revenues is gross margins. So that gives you a sense of the profitability of the product itself. Now, the problem with Tattoo Chef is their gross margins went from 15% to negative 10%. What that means is that for every $100 of product they're selling, they're losing $10. Why that happens is because inflation started to hit in 2022 and the cost of everything went up. Materials, logistics, storage, labor, and they couldn't raise their prices because they're already the highest price product in the market. But the problem here is now they have a real fundamental problem of profitability. If your product loses money every time you sell it, your company has a 0% chance of ever making money in the future. And that's a business that's guaranteed to fail. I hope you enjoyed. If you like this, like and subscribe, and I will see you in the next video.